Hi everyone. So today we'll study the 15th chapter of your market risk. The name of the chapter is The Art of Term Structure Models, Volatility and Distribution. This chapter is in continuation of the 14th chapter of your market risk, which is Art of Term Structure Models, Drift. Right? Ultimately, what are we studying here? We are studying the term structure models, right? Basically, we are trying to model the interest rate. In previous chapter, the chapter number 14th, right? We started with very simple basic models. We started with no drift model. Then we moved to your constant drift model. And then we moved to your time varying drift, which is also called as your holy model, which was the first arbitrage free model we saw. And then we moved to your Vasicek model, which not only was an arbitrage free model, but also had a mean divergent property. Okay. So pretty basic, pretty simple. And we also compared, right? We also compared all those models from the perspective of their use cases, from the perspective of their assumptions, from the perspective of what kind of volatility structure they can capture, whether they are theoretical only, whether they are practical. If they are practical, what exactly do they capture? What exactly do they miss? Right? And we ended the chapter by discussing the effectiveness of each of those models. And ultimately, the consensus view was that Vasicek model is a great model because it incorporates your mean reverting property, right, of the interest rate, as well as it's a arbitrage free model. So we stopped there, right? So that was a good discussion of the chapter number 14, where we studied art of term structure models, drift. Now here in chapter number 15, right, we are studying the art of term structure models, volatility and distribution, right? So we are doing what? We are going one step ahead. We are now focusing on volatility and distribution, right? So these two additional factors coming here, and that's why this chapter is divided into two parts. One is your module one, which is about your time dependent volatility models, right? And then module number two, which is your Cox, Ingersoll Ross, and your Lognormal models, right? Without further ado, right, we should move ahead. I'll try to go as much deep as possible in these models, try to make you understand the assumptions, the practical use cases, the gaps, and the effectiveness of each model, right? One point which I want to highlight here is that we are studying these models from the perspective of FRM Part 2 only, right? So basically, FRM Part 2 is a theoretical exam, right? So the testing is basically theory. You don't have a practical testing there, right? So our focus here will be to follow what is asked in exam. And we will cover the theoretical part of these models. Anybody who's trying to learn this model from the practical perspective, right? For him, it is also important to understand the implementation part of this model, which unfortunately is not covered in this particular video. We'll try to cover that in another video. But right now, my focus is on only the conceptual understanding of FRM Part 2 models, right? Or for the FRM Part 2 exam, right? But again, that is also very important, right? Because before you go and try to build those models, it's very important that you understand the conceptual background, conceptual understanding, right? Keep that in mind, guys. Very, very, very carefully. Moving on, guys. Let's try to dig deeper. All right. So first, we are trying to study the time-dependent volatility models, right? When we are trying to study time-dependent volatility models to make it easy to understand, we have further subdivided this module into three parts. First one is the understanding of the short-term rate process. Second one is the understanding of short-term rate change and the behavior of standard deviation of rate change. Third one is the model 3 effectiveness. Okay, so there are three parts basically here, and we'll try to understand. I hope you guys remember from chapter number 14. If you haven't watched that lecture, you can go back and see that video. Ultimately, we are doing here the analysis of the short-term rate, Why we are doing the analysis of short-term rate? Because we believe that if we are able to model the short-term rate, then modeling the long-term rate will not be different or difficult, because it is just the aggregation of the short-term rates, right? So that's the basic thinking behind it, right? Nobody should think that why we are not modeling the long-term rate, right? So basic understanding here is that if we are able to model the short-term rate, then aggregation of all these short-term rates, which as such lead to your conversion to the long-term rate, right? So keep that thing in mind. And then what is model 3? Model 3 is basically the name given to one of the time-dependent volatility models. I'll explain you that. There is a peculiarity about model 3. There is a particular way we have modeled the volatility, and that is one part of your time-dependent volatility models, right? So again, without any break, now let's go dig deeper into each of these topics. Fine. So here, so again, I think this part is pretty straightforward, pretty basic. We are trying to highlight here is that we are ultimately, what are we doing? Ultimately, we are trying to model the short-term rate. When we are trying to model the short-term rate, right, we are saying the generic, continuously compounded, instantaneous rate, right? We are giving that name to the rate we are trying to model, RT, and we say that the generic, continuously compounded, instantaneous rate changes in a particular way, right? So if you understand what we did in the previous models, right, your constant volatility, your constant drift, right, all these things, right? So we started with what? We started with your pretty basic model, dr is equal to sigma dw. This was model 1, right? Then we moved to constant your drift, right? Then we moved to your lambda dt plus sigma dw. Then we move to your holy model, right? Holy model, right? What did we do in holy model? We moved to dr is equal to lambda t time varying drift plus your sigma dw, right? Now here, now we're not going into Vasicek model right now. Vasicek was different, guys, right? Vasicek was what? Vasicek was dr is equal to your k theta minus r dt and sigma dw. This was Vasicek, right? So these are the models we have already studied, guys. Now we are getting into next level, right? Now we are saying is, okay, the model which is given here, now I'll draw a short line just to make it very clear, is that this above part has already been covered in your previous chapter. So if you have any doubt about it, please go back and see those chapters. I don't think there should be any issue in the understanding part. Okay. Now here what we are saying is that the generic continuously compounded instantaneous rate is dr is equal to your lambda t dt plus your sigma t dw, right? What additional factor I have added here? The additional factor which I have added here, which is an addition to what we studied in your holy model, was that now my volatility is no longer your sigma dw, guys. My volatility in your holy model, which we studied, was sigma dw. Here I am adding a time dependent factor, sigma t dw, right? Sigma t dw I am adding. So that's what we have. Okay, so that's what the addition is. Okay, this model extends your model 1 with no drift by including your time dependent drift and volatility, right? So that's pretty straightforward, right? Dr sigma dw was model 1, and now we are moving to this part, right? So we have your time dependent volatility as well as time dependent volatility is this guy. This is time varying drift. Time varying drift was part of your holy model, which was again, holy model was your extension of your basic model 1 with no drift, right? So it also extends the holy model by incorporating your non-constant volatility, which I told you, right, now includes your sigma t. And in these model, dw is normally distributed with a mean of 0 and standard deviation of under root t, right? That's pretty straightforward. Why? Because dw is a random process, right? Random process, right? When you take a random process, right? Random process will definitely have a mean of zero, right? Because that's what we want, right? We want a deterministic part in the model, we want the random part in the model, and the random part mean value has to be zero, right? We understood that a long way in our FRM1 discussion also when we studied your linear regression, multiple regression, we studied that the mean value, the expected value of the error terms or the random part was always zero, right? Standard deviation that we have to keep in mind because see this is a random process and that too dealing with your interest rate, right? And then in this part, we are considering that your interest rates are kind of dependent on what? Dependent on kind of t, right? Dependent on your time period, right? So that is your root dt. Okay, this part please remember, even though this part was also covered in the previous chapter, so that's pretty straightforward. Okay, I hope you have got the essence of what we are discussing right now. It's pretty straightforward, pretty simple. It's an extension of what we have studied earlier in chapter number 14, and we are trying to now say that okay, we have another model where we are trying to model the generic continuously compounded instantaneous rate, by different structures, right? And we need to keep that in mind. Okay, all right, guys. With this, let's move to the next one. Now, next one is the understanding of short-term rate change. Please keep in mind, it's not short-term rate; it's the change of the rate, right? Short-term rate change and the behavior of standard deviation of rate change, right? So, one is the change in the short-term rate, another is the behavior of standard deviation of rate change, right? So, what we need to understand here is since we are discussing your time dependent volatility. Since we are discussing the time dependent volatility means the volatility is not constant. Volatility is changing. Now, once the volatility is changing, we need to know that okay, once the volatility changes, what happens to the change in the short term rate? And what exactly is the behavior of the standard deviation of rate change? Again, very technical, very important subtopic here, right? So try to understand that. Overall, what we say that the volatilities, right? Volatilities can take any value, right? Volatilities of the short-term rate, let's say in the first year can be 220 bips, and then in the next year can be 260 bips, right? So volatility is something which can have any value, it can have limitless number of combinations, right? Now, when we build a model, right? We need to have a certain kind of parameterization, certain kind of boundaries, so that we put values and get a kind of formula, right? So that's where the researchers or the finance people came out that if we have to, like, what was the model, right? The model we started with dr, the rate is dependent on time varying drift and your time varying volatility. Now the question comes is that okay, you want to incorporate your time varying volatility. How do you incorporate that? So there, a new model came into. Now this is named as model number three, guys. A new model comes into being, and that model says that okay, fine. Now to include this time varying property, this time dependent volatility, why not keep it as your what you say the exponential decay part, right? So what we are saying here is that we are considering, this is one of the cases, guys, one of the cases we are considering that instead of sigma t dw, we are saying that why not we consider as sigma exponential minus alpha t dw, right? So the whole point here is we are considering, right? We are considering the exponential decrease to zero for all alpha greater than zero, right? Exponential decrease to zero for all alpha greater than zero, right? So again, it's a type of model. The name of this model is model number three, where we are considering the exponential decrease to zero. And also, please keep in mind the what is sigma? Sigma represents volatility at t0, right? So this is right. This part is not zero. This is volatility at t0. Means it is the initial volatility. Volatility at t0. And then we are saying that volatility at T0 at the starting of the period is this much, but we are considering that as we progress ahead, as we move ahead, the volatility is decreasing, right? The exponential decrease in the volatility happens and it moves towards zero for all alpha, which is the parameter here, greater than zero, right? And then we have done some calculation, right? So that's pretty straightforward. But more importantly, what you need to understand is that this is one of the models where we're trying to understand that, fine, we understand that we need a time dependent volatility model, but now we also need to understand the how the short term rate change is happening and what the behavior of the standard deviation of rate change, right? So this is what we do. We put the values in the model. Like this is the model we have now. These are the model number 3. You put the value, you get some number, right? You did do the calculation. See, this is your guys lambda, right? If you put it very simple, this is lambda. Then lambda will be multiplied by what? Lambda will be multiplied by your dt, right? UDT, right? Which is 1 by 12, right? Dt is 1 by 12. And then this is the time varying drift you are talking about. Then your sigma is your volatility at the T0, which is 1.5%, which is again given. Exponential minus alpha is given 0.3. dw is your value of the random process, which is given 0.2, and this comes out as 0.31, right? So the new short-term rate which comes out is, right, so this is the dr, guys. This is the dr means the rate change. Somebody asks you the new short-term rate, right? That means you are adding the old rate, right? New short-term rate would be what? New short-term rate would be the old rate plus the addition of the new, or addition of the dr part, right? R0 plus dr, and that makes it your new rate, right? This value is slightly less than your constant volatility, which is 5.32% due to the exponential decay in volatility, right? That's what we have. All right. So keep that thing in mind very, very clearly. If you understand that, I think you will be in good shape for the exam. Okay. Last point is also very important, guys. Please don't kind of miss it. Please keep in mind here when we are discussing this model number 3, we are deliberating, or we are deliberately incorporating, right, your volatility as a exponential decrease. So volatility is decreasing. Now, if volatility is decreasing, obviously, if you compare the values which are coming out, dr which is coming out from this model, that will be less than your constant volatility, because here the volatility is decreasing, right? Exponential decay in volatility. I think that will make sense. I don't think there should be any problem here. Moving on, guys. Next part here is the effectiveness of model 3. Now, this is, I think, the one of the most important slide from the FRM part 2 perspective, right? If you're a student who is looking for your deeper understanding of your model 3, and you want to have a comparison, right? Want to have a comparative view that how this model behaves in comparison to other model 1 and model 2, and what we need to keep in mind. I think this is a very good slide to have a holistic view, right? Time dependent volatility models, right, offer your increased flexibility for modeling your future short term rate. Very straightforward, very simple point. Definitely, right, when you are taking a time dependent volatility models, you definitely have an advantage, because now you are not sticking with a very simplistic assumption of constant volatility. We believe, right, or in fact everybody knows in the reality, in the real world, that if you are putting an assumption that volatility is constant, that assumption doesn't work out, right? If you go back and see any kind of model where the even if you have studied that in FRM part 1, you know that, right? The Black-Scholes model. What is the biggest drawback of Black-Scholes model? The biggest drawback of Black-Scholes model was that the volatility was assumed to be constant, right? Even though Black-Scholes model has won Nobel Prize in 1990s, right? People who made Black-Scholes model, they won Nobel Prize, right? But if somebody talks about the biggest limitation of that model, that it has your assumption of the constant volatility. We have to do it because we want to simplify things. But when we try to move our models to the realistic world, right, then we say that, okay, when we're moving to a realistic world, this doesn't work out, right? So we'll go ahead and see all those things also. So don't worry about that, guys. But what you need to know right now is that it gives you an increased flexibility. Next point is that these models are kind of useful for pricing your multi-period derivatives like your interest rate caps and floor. Very straightforward again. Again, if you understand it, because see, when you are looking at multi-period derivatives, right? When you are looking at understanding a multi-period derivative, right? it is very important that you understand the perspective that volatility will not be constant, right? Because volatility will be a function of those multiple periods. And since volatility will be a function of those multiple periods because of a time dependent volatility, we need a time dependent volatility model. And in that case, model 3 works very fine, right? Next point is your comparison with Vasicek model. Comparison with Vasicek model is also very important because what you need to understand here is Vasicek model, which we studied previously, right? Which I gave you in the previous slide. Vasicek model was what, guys? dr is equal to k theta minus r dt, a small correction, dt plus sigma dw, right? What is happening in Vasicek model? You are keeping an assumption of mean reverting, and this was the speed of the mean reversion, right? This was the constant speed of the mean reversion, right? This was the constant your speed of the mean reversion. Okay. All right. Now when you try to compare model 3 with your Vasicek model, right? So what we need to understand here is if initial volatility and decay rate in model 3 are equal to the initial volatility and mean reversion rate in the Vasicek volatility, their terminal distributions, right? The terminal distribution will have the same standard deviation. What is the name of this chapter, guys? The name of this chapter is Art of Term Structure Models, Volatility and Distributions, right? So we need to understand the shape, the form, the properties of distributions as well. The name of the chapter states it's very clear, right? So this is again a very good property. Why do we need to know about distributions? I think you have learned enough of quant in your FRM part 1. Do you know that once you have a basic idea of the distribution, it becomes very easy to draw general inferences, general hypotheses about the values which are part of the values which you consider in your analysis, right? So what has been seen here is, right, that the initial volatility, right? So if you write both models now side by side, if you write this model and this is your Vasicek model, and if I write this model, okay, which is your lambda t dt and your sigma e minus your alpha t dw, right? If I compare both these models, right? So if I take both these models together, right? What we are saying here, right? This is from where I've taken, guys. This is the same thing which is given, right? Alpha t dw, right? If I compare these two models together, what is the analysis we are drawing? The analysis we are drawing here is that if initial volatility means sigma of your, let's say, sigma of Vasicek, right, and sigma of your model number 3, if sigma are same, means volatility is same, right? And right, initial volatility, not the obviously we are considering the initial volatility here only, right? And the decay rate here is alpha, right? So decay rate is alpha is are equal to initial volatility and mean rate. Decay rate is equal to your k, right? If that is the case, we are drawing an analysis about the terminal distribution. Again, very technical point, guys. We don't have like there is a detailed analysis and detailed derivation of this part, but considering the FRM part 2, and since we don't want to get into too much of maths here right now, so there is a description and derivation of this result. But I think for exam perspective, it is more important that just we remember that if the initial volatilities are same and the decay rate of model 3 is equal to the mean reversion rate in the Vasicek model, right, which is the speed of mean reversion k, right, their terminal distributions will have the same standard deviation. Very important property, guys. Please remember for exam, terminal distribution have same standard deviation. So we know that the change, right? The change would be same. Next property. Next property is very important again, guys. Here we are saying that the time dependent drift in model 3. Time dependent drift in model 3. What is time dependent drift? This is time dependent, right? Equals the average interest rate path in the Wassercheck model. Very peculiar point, right? Time dependent your drift, right? Which is your lambda t, right? dt is equal to the average interest rate path. Again, it makes logically complete sense, right? Why it makes logically complete sense? Because ultimately, when you are modeling, right, you are looking at the average interest rate path. In the Wassercheck model, you might have many discussions about or many values for the mean divergence, but ultimately you're looking at the average interest rate path, right? So when we are looking at the average interest rate path, okay, uh, in that case, right, in that case, what has been observed, right, that if the time dependent drift is equal to average interest rate path of what? Your Wassercheck model. The terminal distributions are identical. Okay. Again, lengthy derivation here again. We are not getting to that part, but just logically, if you see, it makes sense because we are talking in one side, we are talking about average interest rate path of Wassercheck model. On the other side, I'm talking about your lambda TDT, which is time dependent kind of drift, right? So we are comparing two different models. We are trying to get to a middle ground, and we are saying that okay, the time dependent drift, right, which is again dependent on your time and the different time periods, that is equal to the average interest rate path, the middle value, right? Their terminal distributions are identical, right? Which makes sense because it means that the volatility function of the drift is behaving very similar to the average interest rate path. And average interest rate path is what? Average interest rate path is also the deterministic path, right? It's not the average interest rate path. What is it trying to capture, right? Average. I'm saying average, the mean value. The mean value, average value is the deterministic part of the model, right? So if the deterministic part of the model is equal to the deterministic part of your model 3, please understand, I've covered this in previous chapter, but any model which you are building, right? This part is deterministic. This part is random, right? So drift part is deterministic, right? That's why it's called drift. And the part which is with the DW, which is random, is your random part, right? So if the deterministic path of your model 3 is equal to the average interest rate path of your Wassercheck model, right? So what are we doing? We are saying deterministic part of model 3 is equal to average or the mean value, which is again a deterministic part of Wassercheck model. If both deterministic parts are equal, so it means that those are almost identical, right? The noise part is different, right? But the terminal distribution will be identical, right? So if you try to understand this logically, this makes perfect sense. Right? We don't need to get into derivation, right? But overall, my point here is that from an FRM exam perspective, please be very careful about these two properties because these are asked in exam quite often. So you need to know this, right? And remember the name of the chapter. The name of the chapter is time dependent volatility and your distributions, volatility and distributions. Okay. So these were the comparisons. These were the good points. These were the similarities. Now we get into your differences. Okay. When we talk about differences, right? So model 3 will experience a parallel shift in the yield curve, parallel shift, very important, from a change in the short-term rate, right? Model 3 is simplistic in nature. Model 3 is very similar to your Holy model. So since it is uh, coming out from Holy model where uh, you're not exactly looking at capturing the nitty-gritties of the yield curve. So in model 3, even though you are still capturing time dependent drift and time dependent uh, volatility, but the time dependent volatility here has been assumed very simple, right? We have assumed the time dependent volatility as a decreasing function, right? We have assumed that to an exponential decrease to zero with time, which is again a very simplistic assumption, right? So if you are killing the random part, right, because you are ultimately saying that your random part, which consists of exponential e minus alpha t, right, which is decreasing function, which decrease to zero, ultimately what we mean here is that the randomness is getting zero, right? If you are killing the random part, right, you will not be able to capture the non-parallel shift. You will only be able to capture the simplistic part of the yield curve, which is the parallel shift, right? So again, understand it logically very easily. Now, with this background that you understand that okay, model 3 only captures the parallel shift, what do we do now? The next part here is that if you want to price your options, right? If you want to price your options uh, on the fixed income instruments, right? Because we are talking about interest rate, guys. We'll deal with fixed income instruments only, right? Callable bond, puttable bond, etc., right? So if you are looking at for pricing option on your fixed income instrument, volatility dependent models are preferred for your market price interpolation, right? Volatility dependent, right? Why? Because when you are trying to, please understand, right? When you are trying to price options, right? When you're trying to price option, volatility is a very critical factor. You remember clearly when you're trying to price options by your Black-Scholes model also, then also volatility was very important factor, right? Volatility was one of the input metric, right? So in that kind of thing, any change in the volatility directly affects your pricing part, right? So we want to be very clear. So we want that thing, your time dependent volatility. However, a niche point also comes out from here. The niche point is that if you are looking for valuing or hedging your fixed income securities or option, then we are actually not uh, looking for your what you say volatility dependent models, but we are looking for your mean reversion models. Now, this sounds little tricky because why would somebody have so, right? Unless you understand the difference between your pricing and valuing or hedging, I think this question is very difficult to answer, right? So point here is that see, when you are valuing or hedging, again it's a very conceptual point, please guys try to understand. When you are valuing or hedging, your perspective is not the overall value. Your perspective is the relative path, right? That what is the relative path of the one instrument or one option with another, right? When you are looking for that realistic part, when you are looking for that, not the absolute value, in that case, mean reversion does a good job because in mean reversion, you are able to look at that realistic part or you can look at that relative part, right? So very peculiar point, I would say, not easy to understand in the first go, right? But again, very important from the exam perspective. I'm trying to highlight what all exam question can come in here, guys. Please remember this: when you are pricing an option, we need a model that fits today's yield curve. When you're looking at a model which is fitting today's yield curve, we can't have an assumption of your constant volatility. We need to have an assumption of volatility dependence. Even model 3 will not work that well because here we have taken little bit of volatility dependence, but ultimately we are saying the volatility is going down to zero. But we need niche volatility dependent models. Why? Because when you are trying to model your pricing of option, you need models that mirror that kind of fits today's volatility surface. When when we flip to valuing or hedging, right, things are different. When you switch to valuing hedging, things are very different. There, your mean divergent models are more suitable. Why the mean divergent models are more suitable? In that case, right, in that case, things are very different, right? In that case, we are looking at the relative path, relative move, right? So in that case, since we're not dealing with today's yield curve, we don't want a specific value, we don't want that all those time dependent volatility. The same thing can be easily done by your mean divergent model, right? So it's a relative advantage, right? It's not a absolute advantage, I would say, right? It's a relative advantage where one model works much better than other model. But again, you need to remember this because this comes in exam, guys. A criticism of the time-dependent volatility is that these models assume the markets or forecast for the short-term volatility far into the future. Yeah, that's a valid criticism, guys, because what you're seeing here is that, see, it's a time-dependent volatility model. You do the forecasting far into the future. That might change because the regime never stays same. The volatility never stays same. So the regime changes, right? The volatility changes. So any forecast which you are doing today on the reference of what will be future volatility, which might not hold true, right? Which is unlikely, right? So this is again a pain point which you need to understand. So a compromise or the better way is to forecast volatility approaching a constant value. In this case, model 3, the volatility approaches 0, right? This is one of the most simplistic assumption. Now you must be, now you must know, right, that why ultimately we are doing it. We are ultimately doing this, right? We are ultimately considering this part that, okay, we are moving into that. Let's say we have time dependent volatility and we are saying that volatility ultimately approaches 0. Why are we doing that? Because we are trying to kill this point. We are trying to kill this point that we can't forecast short-term volatility far into the future, right? So if we are trying to forecast volatility into the future, right, we need to have clarity. We need to have a clarity, and we need to come with a premise that, okay, we can't do that, so we are taking one of the approaches, right? Whether this approach is foolproof, that's a question of debate. We'll not go there, but what you need to understand here is that as we progress ahead, we say that as we go with the time, the volatility will not be constant, right? As we move ahead, the volatility approaches the constant value and the volatility moves towards 0, right? Remember this. See, I told you, right, this slide is one of the most important slides for your exam. Why? Because FRM part 2 does not go into the modeling part in practical sense. FRM part 2 go into modeling part in the conceptual sense. When we are going to the modeling part in the conceptual sense, it is very important that you are able to understand concepts conceptually, that you are able to understand the logic behind it, you are able to understand and correlate different dots, different points, so that you can correlate and understand them better, right? So that's what my endeavor is, that I want to make it very, very clear. And you have to join those dots with the previous topics also, guys. So you have to constantly understand, constantly benchmark your understanding with the previous model's understanding, and you have to do the comparative analysis constantly, because that's how exam will ask you. Exam will ask you that, okay, which of the following statements are true, etc., such kind of questions. So if you want to answer such kind of question, you need to have a very clear understanding, very clearly understand a holistic understanding, which will not work if you don't, which you have not studied concepts in a better way, right? Last but not the least, mean divergent models, right, which was Vasicek model, are favored for their downward sloping volatility term structure. Again, very interesting point, right? See, again, they are saying that, okay, we have compared model 3 with the Vasicek model, mean divergent model. Which is a mean divergent model? It's a Vasicek model, right? We are saying that mean divergent models are followed. I know that, right? We all know that. We studied Vasicek model in the previous chapter also, and we said that Vasicek model is a good model because it is uncooperating one of the most important properties, which is the mean divergence. Right here, we are saying that, okay, we are comparing mean divergent model with your model 3, and we are saying that mean divergent models are favored. Why? Because in mean divergent models, you are incorporating, right, the downward sloping volatility term structure, because we are saying at the time progress, the volatility has a downward sloping volatility, right? Longer the time, right, the term structure of the volatility is your downward sloping. Please don't confuse. It's a downward sloping volatility term structure. It's not the downward sloping interest rate term structure, right? It's the about the volatility. Now somebody will ask that, sir, why volatility term structure? Because that's what the chapter is. We are trying to understand the effect of volatility on your art of term structure models, right? So the chapter name is art of term structure model, volatility and distribution. So here we are talking about volatility term structure. Now somebody will ask that, why we are having a downward sloping volatility term structure? We are having a downward sloping volatility term structure because If you go back to FRM part 1, there also you have studied that volatility has regimes, right? Volatility has a quiet regime, volatility has a panic which came in COVID time, etc. But ultimately, right, the volatility reverts to mean value, right? So there is a if COVID time the volatility went up, right? Ultimately, volatility got back, right? So volatility follows a regime kind of system, and there is a mean reversion, and the volatility term structure is downward nature. It's not about interest rate term structure. Interest rate term structure in the long term is upward moving, or in the upward sloping in the normal term, right? But here we are talking about the volatility term structure. Okay, so keep that distinction in mind, guys. Very important slide from the exam perspective. Please try to understand. I have given you enough background. I think that would make sense. Okay, moving on, guys. Okay, interesting question. Regarding the validity of time-dependent drift model, which of the following statement is are correct? Time-dependent drift models are flexible since volatility from period to period can change. However, volatility must be an increasing function of your short-term rate volatility. Now, this creates a problem. Volatility must be increasing, right? That's not necessary, right? Because volatility, not necessarily that we have an increasing function, right? Time dependent volatility functions are useful for pricing interest rate caps and floor. That makes sense, right? That makes sense. But my problem is the statement number one, when it is saying must be increasing function, right? So I don't think statement one is true. Statement two is true, guys. So I think two only answer should be B. Perfect. That's what it is here. Time dependent volatilities are very flexible. We understand can incorporate increasing, decreasing, and constant short term rate volatilities between periods. So that's what my point was. Only increasing, that doesn't work out. This flexibility is useful for valuing interest rate caps and flow that we have discussed, because there is a potential payout for each period. So the flexibility of changing interest rate is most appropriate than you're applying a constant volatility model, right? So that makes complete sense, right? All right. Next one. Okay. Next one is your CIR, Cox, Ingersoll and Ross, and Lognormal models. Right. There are 5 subtopics here. We need to understand first the CIR model, which is Cox, Ingersoll and Ross model. We'll try to understand the assumption, basic tenets, then properties, then effectiveness. Then we talk about the log normal model, right? Again, basic tenets, effectiveness, and your details. Then we move to the terminal distributions. Again, remember the name of the chapter. The name of chapter was volatility and distribution. So we need to have a deep understanding of terminal distribution for all your normal model, your CIR model, and your log normal model, right? And then we'll talk about 2 important things. We'll dig deeper into log normal model. We'll try to understand the log normal model with deterministic drift, and we'll try to understand the log normal model with mean reversion, right? So we're going into a little advanced level. We'll try to mix few of the concepts, and we'll come with more effective, more better models. Okay. So keep that in mind, guys. Please focus, right? It's more, this second module is quite tricky compared to the first module. Okay. Let's dig deeper. All right. Now the next part here is the understanding of the Cox, Ingersoll and Ross model, CIR model. The important point here is you can go back and check your previous chapter. CIR is not a arbitrage free model. CIR is actually a equilibrium model. Okay. When I say equilibrium model, basically equilibrium model does not follow the properties of arbitrage free model, where we say that the property of your no arbitrage will always hold constant, right? So it is not that model. It's an equilibrium model. It's a very famous model, guys, because in this model we are incorporating, right? If you keep in, if you try to understand in generic sense, we try to incorporate your macroeconomic factors, and you try to incorporate the understanding of your inflation, your understanding of your expectation, your understanding of macroeconomics, and we study these models, right? So that's a basic ground I'm building. Okay, so these models have a very distinctive kind of positioning, right? What happens here is that the model described earlier, right, what we have studied earlier, right, which was your model one with no drift, model one with constant drift, model one with time varying drift, and then moving on to Wasserchick model and your time dependent volatility model. The model described earlier where there is there's a difference, right? So the model described earlier had a very unique proposition, right? When I say the unique proposition there was that we had an assumption that basis point volatility, basis point, guys, please understand, basis point volatility is not volatility. Basis point volatility is different from your volatility. First point is that, right? So basis point volatility is sigma R. Please understand that point very clearly, guys. Small difference, but very important if you want to learn this pretty well. Sigma R is your basis point volatility. Sigma is your volatility. Okay, sigma R is a basis point volatility. Sigma is your volatility. Right, keep that thing in mind. Okay. Now the point which comes here is that we are looking at your basis point volatility, and this basis point volatility is kind of independent of the short-term rate, which was a conclusion which was built in the previous model, right? That has been called very questionable, right? And that makes sense also, right? Because we are considering that basis point volatility, which is sigma R, not at all depends on the short-term volatility. Means the change in the volatility is not dependent on the short-term volatility, right? That was the problem, right? We are saying that dr, right, sigma r, or the basis point volatility, you can also say dr, right, change in the volatility, right, is not dependent on the r, right? That is the point, right? So then some examples have been incorporated here, that when we see the data during high inflation, right? During high inflation, we see that if you're looking at changes in your rates, the change in the rates are likely larger during your high inflation, right? Again, practical data, practical scenario, it has been observed in the empirical analysis. So why this is that changes in the rates are likely larger during high inflation? Because the changes in the rate dr is dependent somewhere on the r, na? The dr is somewhere dependent on the r, right? Volatility should be smaller in extremely low interest rate environments due to downside barrier at zero. This was also observed, right? So this is when this kind of empirical analysis matches with the theoretical consideration of model which we did earlier, then a point which comes out here is that are our theoretical analysis, or our theoretical assumptions actually true? And when we kind of try to figure it out, we realize that even though our theoretical models are good, but maybe they are lacking somewhere in the practicality, and that's where there is a requirement of the equilibrium model, which try to incorporate your inflation, your expectation, your macroeconomic things to make the existing model much better. So CIR model is basically an extension. It's an extension of your Wasserchick model, right? Where we say that the basis point volatility, which is your sigma R or dr, increases with the short rate. And why did we do that? We did that because we are kind of what you say. We are kind of looking at what? We are kind of looking at your empirical data that changes in the rates were higher in during high inflation, volatility in the low interest rate environment is quite low, right? So we keep that, right? Now we have studied the Wasserchick model, right? When we have studied the Wasserchick model, what did we study? We studied in the Wasserchick model that dr is equal to your k, your theta minus r, right, dt, and your sigma dw, right? This is where the problem incorporates in your CIR model. CIR model says that no, we need to incorporate the basis point volatility, and we need to talk about, because basis point volatility is short-term volatility, and we need to incorporate that basis point volatility increases the square root of the root r. So that's why the dr, this was Wasserchick model, right? This was your Wasserchick model, right? The CIR says dr is equal to k theta minus r dt, and your sigma, your root r, and your dw. So what we are saying here is that basis point volatility increases proportionally to the square root of the root r. Again, see, I am assuming in this model that it increases proportionate square root of the root r, right? So this is one of the model, right? In other model, things can be different, right? But what we are putting across here is that we need to incorporate some point, keeping in mind the practicality of the models, right? Where if sigma is constant, dr increases at a decreasing rate. Very important, please understand that dr is increasing at a decreasing rate in CR model, right? Again, thereafter it is simple. I think you need to just put the values, right? The things are given here. This is k, speed of mean reversion. This is theta, your long-term rate. This is r, the short-term rate. This is dt, which is 1 by 12. The sigma 1.5%, right? You put different values, and then you get it, right? Then you just substitute your, I think 1.5%. I think there is some miscalculation here, guys. I think this should multiply by this one, and then your some miscalculation has happened here. Hey, please check this calculation, right? Just numbers are placed opposite. I think dw is 0.20, so this should stop here, right? dw should, right, and then you add the value. Ultimately, you get this value, right? Some miscalculation, but keep that clarity in your mind, right? I don't think, just substitute the values here, right? I think that will make perfect sense, right? The new short-term rate, right, at 0.13 is dr, right, and that will boil down to your, you add the dr in the old short rate, which comes 5.13. Okay. All right. Moving on, guys. The next one is another interesting model, right? When you talk about another model here is your log normal model. Okay. When you talk about the log normal model in your FRM part 2 has been named as model number 4, right? So model number 4 is another common specification where we keep the same premise. The premise is that the basis point volatility increases with the short-term rate. Again, be specific here, guys. FRM part 2 is very tricky in that sense, that we are keeping it the basis point volatility increases with the short-term rate. I am not saying that basis point volatility increases with the short-term rate by root r. I am not saying that. I'm just saying that the basis point volatility increases with the short-term rate, right? That keep in mind, right? There's a difference, right? I'm saying increases. I'm not saying increases by root r, right? Or it increases with a decreasing function. Root r is a decreasing function. I'm not saying that, right? Because root r is r raised to power 1 by 2, which is a decreasing function, right? I'm not saying that. I'm just saying it increases with the short-term rate. Keep that distinction in mind. Yield volatility is constant, but basis point volatility equals to sigma r. Now, this is tricky. Please understand. There, again, same thing. This is what I'm telling you. Basis point volatility of sigma r increases with the level of the short-term rate. Right there, I was saying increases with the level of the root of the short-term rate. In your previous model, in your previous analysis, which we did in the previous slide, right? I was saying that in CIR model, the basis point volatility increases proportionally to the square root of the root r. Here I'm saying it is increasing proportionally, right, with the level of the short-term rate, r. It is r. There it was root r. Here it is r. Right? There it was decreasing function. Here it is increasing function. Right? So formula, please keep in mind, dr is equal to ar dt and sigma r dw. Right? Sigma r dw. Okay, remember that very, very clearly. Small model, simple model, but certain properties has to be understood, right? Now, once you have understood both models, the differences, etc., the next point comes is that how do we select different models, right? What could be my heuristics, my benchmark, my analysis, understanding that how do I select the model, right? When I select the model, when we look at the model selection consideration, in both your CIR and your log normal model, a positive drift prevents the short-term rate from becoming negative, right? Remember this very peculiar property, right? In both model, right? See, if you are incorporating a positive drift, right? Here you have ARDT, right? What were you having in the previous one? In the CR model, what was the drift, guys? If you go back to CR model, what was the drift? You want to say it, right? It was what? K theta minus R dt, right? Again, both were positive cases, right? In both positive cases, prevent the short-term rate from becoming negative. That's a good thing, right? Because as we have studied in the previous chapter, we don't want short-term rates becoming negative because that doesn't make economic sense. It might make modeling sense, it might make mathematical sense, but in the economics perspective, negative rates is a very rare phenomenon, even though that has happened once in recent past in Switzerland in COVID times when the rate went negative, right? And for many years, like almost 30 years, it was there in Japan when the rates were kept negative. Now they are no longer, right? But those are exceptions, right? In more than 200 countries, if two countries are doing something, and that too in the rarest of scenario, that is not a economic sense, right? That's not a normal thing. So we don't want negative thing as long as the rate starts positive, which is a good point, right? This feature is useful but may not be critical in practice. That's perfect understanding. If market makers explain, now this is again an interesting property. If market makers expect flat interest rates and minimal impact from your negative rates, right? They may prefer your simpler constant volatility models over the more complex CR models, right? They may prefer simpler constant volatility model over the more complex CR model. See, the point here is CIR model was based on what? CR model was based on your Wasserchick model. Basically, CR model was incorporating what? Two things. One was the mean reversion property. Second was what? Second was what? Second, it was incorporating your time dependent volatility, right? And we were, you know, taking what? Your sigma root r, right? Uh, your we are saying that not we should not use time dependent volatility model name. Time dependent volatility model, you have sigma t. Here we're using your sigma root r. We were saying that the basis point volatility is dependent on your short term rate, right? So use the correct terminology, guys, right? So they may prefer simpler constant volatility model. That makes sense, right? That makes complete sense because we don't want a complex CR model because that has mean reversion property and then you have your sigma root r, right? If you are expecting a flat interest rate, means you are not trying to model or mimic the actual interest rate, right? If you're expecting flat interest rate, which is the most simplistic assumption, and you're not expecting a negative interest rate, right? Then it makes sense that you follow a constant volatility model because in that case, your analysis and the answer will be pretty straightforward and easy, right? So this is just a heuristic, just a benchmark or thumb rule that what you need to follow to get the answer, right? Keep that in mind, guys, very carefully. Moving on. Now, interesting question. Which of the following choices correctly characterizes your basis point volatility and yield volatility? Please understand, basis point volatility is different, yield volatility is different as a function of the level of the rate within the log normal model, right? So, if you look at the basis point volatility and yield volatility, right? One point is, please understand, we haven't talked about yield volatility at all. We have discussed your basis point volatility, right? So in that case, and don't get confused with different discussion, right? There is a volatility term structure which is different. Here we are talking about yield volatility, right? So first of all, decreases go away. We are looking at constant volatility, right? So okay, in log normal model we are looking at a constant volatility, right? So that's the point. Now, okay, we have two choices, constant and constant, right? Now should I choose A or should I choose your C? Now, in this, what you need to understand is when we look at the basis point volatility, right? Basis point volatility increases, right? Increases, right? Both in your CIR model also it increases. In your log normal model also increases. Log normal model was what? Sigma R, right? Sigma R. So it increases, right? It not decreases. So this gets cut, C gets cut. You're only left with A, right? Only left with A. Remember, this guy is not very difficult. I think if you listen to my lecture properly, I think that will make sense, right? That's what the explanation is saying. Explanation is saying that choices B and D can be eliminated because yield volatility is constant. Basis point volatility under the CR model increases at a decreasing rate, right? Which I told you when I was teaching you. Whereas basis point volatility under the log normal rate increases linearly, right? So both increases. One is a decreasing rate, one increases linearly, right? Question only asks about increases, right? So that question was simpler. But if they twist it. If they ask you increases at what rate, please remember CR model increases at a decreasing rate because it's root R. Log normal model increases linearly because it is your sigma R. Therefore, basis point volatility is an increasing function for both models. That makes sense. But whether it is a decreasing rate, increases at a decreasing rate, that's CIR. Increases linearly, that's log normal. Again, very peculiar, very small point, but you need to understand that's how the questions are framed in FRM. Very conceptual in nature. You need to have a clear understanding. Okay. Now we are moving into your terminal distribution, right? Why I said now, because now our discussion totally changes into your a different angle, right? Now we are focusing on terminal distribution. Again, remember the name of the chapter. The name of the chapter is Art of Term Structure Model, Volatility and Distribution. So your subject, your FRM part 2 focuses on distribution. They want you to understand distribution, and that too for your normal model, that too for your CIR model, that too for your log normal model, right? You need to understand that. So when we look at your uh, a clear cut understanding here, right? See, why are we doing it? We are doing it because if we have a clear understanding of the distribution, we are able to do better analysis. We are able to look at things in a more holistic way. We are able to understand what values a particular model can attain and not attain, and that will give us a very good understanding, right? Benchmarks and analysis, right? So that's what it is, right? So figure, please remember. So this figure has multiple points. What you need to remember here is that please, if you see this dotted line, this is your log normal. If you see this one, right, this is your normal. And when you see the other one, which is this one, this line, right, this is your log, this is your CIR. So there are three different kind of your terminal distribution. Again, you need to remember these properties, guys. These properties are derived by a lot of your mathematical derivation and analysis, and you need to look at things uh, in a very straightforward, interesting way, right? With equal means and standard deviation, the normal model, right, shows a positive probability of negative interest rate. That makes sense, right? Because normal model will be on both sides, right? On the positive side and the negative side. You have read this in your FRM part 1, right? Normal distribution, right? Normal model. It will have negative values, right? That's why for all the positive things, we don't take normal model, right? For stock prices, we don't take normal model, right? Normal distribution. We take the log normal thing, right? Because normal model has an ability to predict the, or normal model has to incorporate negative values, which doesn't make sense in a lot of economic variables. It doesn't make sense in your stock price. It doesn't make sense in your sales. It doesn't make sense in your revenue, right? So you can't do modeling of those things. And in this case, we can use it because sometimes there is chance of negative interest rate. But again, if you stick to the economic rationale, negative interest rate don't make sense. And so relying on the normal model is not such a good idea, right? Theoretical possible, practically impossible. Right. Next is if you're looking at longer forecast horizon, increases the chance of negative rates in the normal world. Again, same point. Higher the data set, higher the horizon, higher the modeling parameterization. Obviously, your values will try to go random and you will have the higher chances of getting a negative rate. Right? That makes perfect sense. The left tail of the normal distribution lies above zero. or negative rates. That also makes sense. Left tail is this. Above zero for negative rates, highlighting a key drawback that I told you we can't have that because some variable doesn't make sense. I gave you an example of different countries, Switzerland, your Japan, most importantly. Unlike the normal distribution, log normal and your CI distributions are always non-negative. Makes sense because both are non-negative. And right skewed, right? Remember that also makes sense, right? You have studied that in FRM part one, right skew and non-negative. Now, what you have to remember in FRM part two, I think, is one line which is very important. With this distribution, this significantly affects the pricing, especially for out of money option. Very, very important point, guys. Why this has to be incorporated? See, understand the point here is when a particular model is non-negative and when a particular model is right skewed, right? What you are looking at the right tail. Right tail is what? Right tail is the tail on the positive side. When you're looking at the tail at the positive side, right? And you're looking at the tail at the positive side, what exactly does that mean? You're looking at your tail values on the upside, your tail values on the positive side. And especially for out of money option, if you have out of money call option, right? That will give you enormous benefit, enormous, reward for betting on the right tail, right? Because let's say you have a S&P 500 right now 6,500, and you bet on December 7,000 call option for S&P 500, right? Uh, if that happens, or right now your money or the option is out, your option is out of money. But if that happens by December, you will make a lot of money, right? So right tail on the upside is very beneficial or significantly affect the pricing, especially in the CI and log normal model, right? Very interesting, guys. Very, very interesting. Again, I have taken an example of equity thing here, but anything which is out of money, right? See, options can be on the bonds also, on the equity also, but the moneyness is very important. Anything out of money, whether it's in bond or equity, that will make sense in your CIR and which will have significant effect on the pricing for your CIR and your log normal model. Okay, so keep that in mind. I think that is one line which is very important for FRM part 2. Rest, I think, is very similar to what you did in FRM part 1, right? Moving on, guys. Next part here is practice question, right? Which of the following statement is most likely a disadvantage of the CR model? Let's read it. Interest rates are always non-negative, right? Always non-negative. Yeah, kind of. I think this is fine, right? So it's not a disadvantage. Option prices from the CR distribution may differ significantly from normal or normal distribution. I told you that makes sense, right? Because if you see the model CIR, if you go back, right? If you go back, you see, right? If you see, compare the three parts, right? Even though I have not highlighted, if you compare the three parts, you see the log normal is inside. Log normal is this dot, right? Log normal is the dotted line. It is inside. Which is the line which is maximum fat tailed? Max fat tailed is your CIR. Right skew and max fat tailed. Max fat tailed. Max your right skew, right? That is your CIR. Okay, keep that in mind. And that's what is the problem, right? Because it significantly affects the pricing is very different, right? So that's a drawback we need to keep in mind. So this seems like the answer. Let's check other option. Basis point volatility increases during periods of high inflation. Yeah, that increases, right? That's what is empirical evidence. That's not a disadvantage, right? Long run interest rate hover around a mean reverting level. That's also seen it happen. That's an advantage, right? That's a good point in the model because we are incorporating the mean reverting level, right? That's a good point, right? So these two things are not there. So I think the answer is B. Very interesting question again. Yeah, makes sense. Choices A and C are disadvantage of your CR model. That makes sense. Out of money options prices may differ with the use of normal or log normal distribution, right? That's what it is. Okay. Before I move ahead, what I want to tell everyone here is that this is a small discussion on your distribution part, terminal distribution part. But this small discussion is very important from the exam, because please do remember the name of the chapter: Art of Term Structure Models, Volatility and Distribution. So very important, guys. Don't just neglect it, right? Remember, uh, quite high chance of coming in exam. Moving on, guys. Now we are moving into little more complexity. What we are doing here is, we are saying let's study the log normal model with deterministic drift, right? So we are moving ahead. We are putting more constraints. We are adding, more realism in the model, right? So we are saying that, okay, let's put your deterministic drift, right? So what we have done is that we are putting model as your DLNR and ATDT plus your sigma DW, right? So if you look at your ATDT, right, and sigma DW, right? So ATDT is what? ATDT, now I am getting into your drift, right? And I have removed what? See, the previous log normal model, if you go back, what was the log normal model, guys, in the previous one? If you go back and see, I just want to show you guys. If you look at the log normal model, what was the model? ARDT sigma RDW. ARDT sigma RDW, right? That was your log normal model, right? So now you compare this. You compare the above model, which is here, with your ARDT plus your what? Plus your sigma RDW. In this one, in the log normal model with deterministic day, what you see here is that we have gone in a different way. First of all, the R has gone, right? R has gone because it's a sigma DW. Here we have sigma DW. So the R has gone from your volatility, the random part. Second part is that instead of ARDT, I am putting your ATDT, right? So this model is quite different from other models. The requirement of this model was that we wanted a model which had deterministic part or heavy deterministic part, because again, see, ultimately deterministic part of the model is more appropriate or more important to judge the distribution. So we generally focus more on the deterministic part, right? So that's what we have done. But deterministic part, we are saying that also kind of has a variability with the time t, right? What are the properties of this log normal model with deterministic drift? The natural log of the short term rate follows a normal distribution. Natural log of your short term rate. Natural log of the short term rate means your LNR, right? They follow a normal distribution. Okay. This model can be used to construct an interest rate tree similar to your Holy model, because it makes sense, right? Because Holy model, what was the thing? Holy model was what, guys? It was done in previous chapter. It was lambda t dt, right? Again, there were time varying drift, right? Where drift can vary, right? So it's very similar, right? And that then we have this calculations, not very difficult, guys. These are your trees, your recombining trees, which you studied in the previous chapter also, right? Please understand the probabilities have been taken as zero point 0.5, zero point 0.5. In every case, we take that. That's how we take, and then we take ln r naught, right? Ln r naught is ln r naught plus a1 dt plus sigma d under root dt, right? And then you have a1 dt, and then you say you go to the next time period. Please remember, A1 and A2 will not be similar. You have different time periods, right? A1 and A2 will not be similar, right? And that's how it is, right? And then we look at the log normal model rate at each node, right? Log normal model at each node. right? You have R naught, and then you have exponential A1 dt plus sigma root dt, and A1 dt minus sigma root dt, right? So again, this is just a conversion, guys. I have taken the exponential, ln R naught becomes R naught, and when I take exponential for this thing, the thing which was ln R naught plus your A1 dt plus your sigma root dt, this whole thing, if I take exponential, right, exponential, it becomes R naught exponential A1 dt plus your sigma root dt, right? Please remember this change, guys. Uh, this small change is very important to understand, because this is what has transpired between this diagram and this diagram, right? This is what how things have moved from one to another, right? So remember that again. I think pretty straightforward. One more thing which I'll tell you, right, which I think is very important to understand. See, here it is your, in the first part here it is ln, this part I'm talking about, ln your natural log plus your a1 plus a2 your dt plus your 2 sigma root dt. Now, if I'm comparing this thing with your taking your exponential, your r naught exponential, right? Your a1 plus, sorry, let me make it a little cleaner, guys, a little dirty. So I'm writing it again, r naught exponential a1 plus at your dt, right? So, and then you have your 2 sigma root dt. Now, the part here is, please understand, see, this is ln r naught plus a1 plus at dt plus 2 sigma dt. Here, it also looks similar, right? It also looks very similar, but see, anybody uh, who has studied higher level mathematics will not get confused. I'm pretty aware of that. But anybody who doesn't come from typical maths background might get confused. Might, again, I'm just being a being a trainer or instructor here. My duty is to put facts in a very simple way. So this might look very simple, but please understand it is exponential and it's a race to power, right? So what is happening here is it is actually what? It is actually your exponential a1 into exponential at, and then we are having your exponential a1 plus at, right? That's how the powers are added, right? So the whole point here is that don't think that the a1 and a2, the drift terms are additive here. In this part, log normal models at each node, the a1 and a2 drift parts are multiplicative. Drift terms are multiplicative, right? When you are taking in R naught way, yeah, drift terms are multiplicative. Okay, keep that thing in mind, guys, very clearly. Okay, now let's dig deeper, right? So that's what they're explaining now. At each node in figure 15.2 is exponentiated. The tree will display the interest rate at each node. For example, the adjusted period A1 upper node would be calculated da da da. R naught, what I did, A1 dt plus your sigma root dt. Unlike your Holy model, where the drift terms are additive, this I told you. The drift terms in log normal models are multiplicative. That also I told you, right? The implication is that all rates increase will always be positive in exponential greater than zero for all x. That also is a good thing we want. Please remember this property, right? Also, since ex is equal to 1 by x, approximate, right, value, and we assume a naught, a1 is 0, dt is 1, then r naught is equal to this. Hence, volatility is the percentage of the rate, right? Volatility is the percentage of the rate, right? Volatility is the percentage of the rate. Okay. So please remember that, right? Volatility is the percentage of the rate. Okay, keep that thing in mind very, very clearly. Okay, hence volatility is a percentage of the rate, right? Again, why do we need to know such properties? Because these properties are asked in exam. Secondly, this also gives a valuable idea that volatility, when we consider, right, volatility is considered as a not a standalone factor, right? We are saying that whatever volatility we are seeing in the system, right, that is not happening randomly, right? That volatility can be actually modeled as a percentage of rate, and that's what we started, right? If you look at our basic assumption of when we started with log normal model and your CR model, right? That's what we started. Now we started now that volatility, that whatever the assumption which were taken in the earlier kind of model, that volatility is independent of the basis point, volatility is independent of the short rate, right? That we were not agreeing in. That's why we studied CIR and log normal model. So here we are again, doing the proof, right? That if we convert your EX, we take EX exponential x is equal to 1 plus x, and we assume E1 is equal to 0 and dt is equal to 1, then your R naught E exponential is equal to R naught 1 plus alpha, and hence we are proving the point same again, that volatility is actually not constant, it's a percentage of the rate, right? So we are proving the same point, that don't consider volatility as constant or independent basis point volatility of the rate. Please consider that the volatility is the percentage of the rate, right? So example is given, if sigma is equal to 20, then the rate in the upper node will be 20% above the current short-term rate. That's a pretty straightforward thing. Okay, keep these points in mind, guys. Very, very simple, very, very interesting. I have highlighted, I have explained, I have given you the logic. I hope you keep those logics understanding in your mind, because those are very, very important to understand, right? If you have that holistic understanding, then only you will be able to solve question. And also, it's not about only solving the question, it's about understanding the conceptual part of the model, so that when you go and try to do the volatility, do the modeling of the interest rate, and you have to incorporate the volatility, you keep these things in mind while doing so. Okay. All right, guys. With that understanding, let's move to the practice question, right? If you look at the practice question, which of the following statement best characterize the difference between the Holy model with drift and the log normal model with drift, right? We know that. I've already told you, right? In the Holy model and the log normal model, the drift terms are multiplied. No, only one of them it is multiplicative. In the Holy model and the log normal model, the drift terms are additive. No, only one there is multiplicative, one additive. In the Holy model, the drift terms are multiplicative. No, it's in the log normal model, right? So this is right. In the Holy model, the drift terms are additive. Yes. In the log normal model, they are multiplicative. Yes. Okay. Again, very straightforward. If you have listened to my lecture properly, if you have understood the things, I don't think anybody of you will face any problem. Okay, this is what has been explained here, guys. The Holy model with drift is very flexible, allowing the drift terms each period to vary, hence the cumulative effect is additive. In contrast, the log normal models with drift allows the drift to vary, but the cumulative effect is multiplicative, right? That's what I told you. Please remember that, keep in mind, understanding, logic, etc. Now we are moving to your Black-Karasinski model, which is your log normal model with your mean reversion, right? So now you see another point, right? What is happening here is we are now incorporating log normal model with your mean reversion. We are saying that, okay, we have seen your uh, Wasserchick model, we have seen your CIR model. What was Wasserchick model? The first model which you saw in the previous chapter, K theta minus R dt plus your sigma dw. This was the first model, very simple, right? This was Wasserchick. Then we move to your CIR. In CIR, dr is equal to your K theta minus R dt. But now we have incorporated under root R dw. Third, in this one now, your log normal model with your okay. So again, a very typical model, right? Very typical model. What we are doing here is we are taking the, instead of dr, we are taking d ln r instead of k, right? If you see if you do a comparative comparison, right? What is happening here is compare with the Vasicek model. Instead of dr, we are taking dlnr. Instead of k, we are taking k also time varying kt. Instead of taking theta minus r, see what changes here. We are taking ln theta t minus ln r, right? Then we have, instead of sigma, I'm taking sigma t, right? So have a deliberate comparison of your Vasicek model, because Vasicek model of the first model we saw the mean reversion property, right? So this is a combination of a log normal distribution and a mean reverting process, right? So log normal distribution is this LNR, right? We have studied, right? And we know that, right? I think this property has been discussed again many times, that the LNR will follow a normal distribution. The natural log of the short-term rate follows a normal distribution and reverts to long-run mean of ln theta t. Remember this point, guys. This was not incorporated in the previous log normal models, right? So this is based on your adjustment parameter kt, right? We have taken to be time varying. And this model, why do we need such model, right? The name is Black-Karasinski model. Why do we need? Because this model offers flexibility by allowing for time varying volatility, right? See, time varying volatility is very important, sigma t, and your mean reversion, right? So we have gone much further now. We incorporated your time varying volatility and mean reversion, and since volatility is time dependent, making the Vasicek model time varying. So that's what we need, right? Then we move to your interest rate tree characteristics. The interest rate tree for this model is more complex, but retains a basic structure similar to your previous model. We don't need to go into that depth, especially if you're looking from the FRM Part 2 exam perspective. Please understand, the model is very complex, but it's a basic structure similar to previous model. It does not produce a naturally recombining interest rate trees, because obviously, you have a lot of parameters here. Now you can force the tree to recombine. So we have forced the tree to recombine in your previous chapter also, when we studied the Vasicek model, right? Here also we can force the tree to recombine. So whenever you take the mean reversion model, you have to force the tree to recombine. Overall, you don't need to remember this formula if you're looking at the exam perspective, because I don't think they will ask this question, but you need to know that there is a way you can force the tree to recombine. It's very similar to what we studied in the previous chapter, guys, the art of term structure model drift, where we are taking the Vasicek model. In the same case, in the last model, when we are studying, when we're saying that we're looking at the mean reversion, we said that due to drift terms, right, ultimately the model was not able to recombine. So we were forcing the model to recombine. We were taking the property of two properties, right? One was your mean property and one was your standard deviation property. Go back and check out the previous lecture. You will understand what I'm talking about. But please understand, we are forcing the tree to recombine, and the time step dt must be calibrated in a detailed way, right? So again, don't go here. Don't. If you want to remember the formula, you can remember. But I don't think this will be asked in exam, right? What you need to understand is that we can always do manipulation. We can force the tree to recombine, and that is very helpful for us to understand. Because why do we want to recombine, right? If that basic question comes to your mind, we want to recombine because if we don't recombine, we will have infinite number of paths, which we don't want, because we are doing a modeling exercise. We want to make it easier, right? So if we want to not have infinite path, we want to have limited path, we need to have a recombination. And if we have to do manipulation to get the recombination, we'll do that, right? That's what we are attaining. So again, the formula, etc., is written here, but I don't think you need to dig deeper in this formula, because that's very complex. What is more important for FRM perspective is that you need to understand the concepts behind it and the exact logic behind it. That is what will be tested in exam, right? So remember that. If you understand that, I think you are in good shape. All right, guys, moving ahead. Next part is, let's solve a question. Which of the following statement is true regarding the Black-Karasinski model, which is your log normal model with the mean reversion? The model produces an interest rate tree that is recombining by definition. No, it not recombining by definition. You have to force recombination. You have to do manipulation. The model produces an interest rate tree that is recombining when the dt variable is manipulated. Yeah, manipulation, that seems fine. The model is time varying and mean reverting with a slow speed of adjustment. Slow speed of adjustment. I didn't talk about slow speed of adjustment anywhere in my explanation, right? That doesn't make sense. The model time varying and mean reverting with a fast speed of adjustment, right? I didn't talk about adjustment at all. See, the first part is okay. Time varying and mean reverting. I get that point, right? Right. But slow speed of adjustment, fast speed of adjustment, that doesn't make sense, right? Very clearly, right? So that's not the point, right? So answer is B, guys. You keep that in mind. So this is what it is, right? If you go ahead, yeah, B is the answer, right? Feature of the time varying mean reverting log normal model is that it will not recombine naturally. You have to do manipulation, other time interval between interest rate changes are recalibrated to force the nodes to recombine. The generic model makes no prediction of the, that's what I said. I did not say anything when I'm teaching you the model. No prediction of the speed of the mean reversion adjustment. So you have to be very careful here, guys. Be specific, be diligent, be deliberate, be judicious, right? When you're choosing any kind of option, don't be like, don't fall for the traps, right? I think you are smart enough now. You move to FRM part two. If you are smart enough to understand, but when you're choosing different models, right, you have to be very, very careful that you choose. There can be traps laid down, right? If you see the previous option, right? If you see your option number C and D, half of the option is correct, right? Model is indeed time varying. Model is indeed mean reverting, but there's no discussion of the slow speed of adjustment, the fast speed of adjustment. So half of the option in C, half of the first half of the option in D, first half of the option in C, both are correct. The later half is incorrect, right? So you have to be judicious, diligent, and very clear about the concept. If you are able to understand that, I think you will be able to solve it, right? So with that, we complete this chapter, guys. I hope you guys would have understood. I have put a lot of effort here to make you understand. So uh, I hope you guys understand, right? I've given you enough example. Again, my perspective here is that this explanation is very good for FRM part 2 perspective. Whenever you're looking at the conceptual part of the modeling, this is very good. Right? You need such kind of understanding. You need to have such kind of basics very clear in your mind. You need to have a very clear idea about effectiveness of each model, whether it is model number 1, 2, 3, 4, and comparative understanding that how one model is different from other, which is more closer to reality. Why are we doing mean reversion? Why are we doing time varying drift? Why are we doing time varying volatility? What advantage we are getting? What is good for out of money options? What is not good for out of money options? Where we are getting problem in pricing of option, where it is useful for your uh, valuing or the hedging part of the options. Why do we need to do it in simpler models? When we have a flat term structure, which model can be chosen better than the other model? Where the complexity increases, where the complexity decreases? You have to be judicious. You have to understand this very holistically, right? There is no use mugging up. There is no use remembering the concepts just for the sake of it, right? You have to understand this. That's why the comparison, the comparative analysis, the assumptions, the descriptions, the use cases, the understanding, the logics, the formulations, right? These are very important when you are trying to understand this kind of chapter, right? So keep this in mind. Keep your concepts clear. Go back and watch this lecture very slowly if you're doing it for the first time in the normal speed. Once you've seen it for the first time, maybe if you're trying to re-watch something, watch it at a faster speed. Your concepts will be very clear. We haven't covered the modeling part, right, which is separate, right? We will try to cover the modeling part separately. Some other video will try to build the model from the scratch and make you understand. But right now, the objective was more focused on your FRM part two, the understanding part, right, and the concepts which come in exam. And you have seen the question now, right? The question tests your holistic understanding. The half of the option might be correct and half of the option might be wrong, right? So be very judicious and careful when you're choosing the option, right? With that I finish here, guys. Hopefully you would have liked the lecture. You would have understood the concepts well, and if that's so, I think that's the best reward for any teacher or any instructor who's trying to teach you, right? If you're able to make the concepts clear for students, that's what we want, right? And with that, I'm signing off. Thank you, guys. Thank you very much.